Banks are not supposed to be nervous about gold. Gold pays no interest, sits in a vault, and for most of modern banking history has been treated as a relic, something central banks kept around out of tradition rather than strategy. So when you start noticing banks, both the central banks that set monetary policy and the commercial banks that run the everyday financial system, quietly changing how they treat gold, that's not a small detail. That's a signal worth taking seriously. And almost nobody outside professional trading desks has connected why two very different kinds of banks are worried about two very different things, both involving the same metal. Start with the fact, separate from what it might mean. Central banks around the world have been net buyers of gold for several consecutive years now, a sustained pattern that shows up clearly in World Gold Council survey data and in the reserve statistics individual central banks publish themselves. That's observable. It's not speculation. What's less obvious and where interpretation comes in is why institutions that can create their own currency, that have no real need for a non-yielding asset sitting in a vault, would choose to accumulate more of it year after year rather than holding more government bonds, which at least pay interest. To understand that, you have to go back to something that happened in the currency markets that most retail investors never think about twice: the freezing of a major country's foreign exchange reserves following geopolitical sanctions. Setting aside the politics of that specific event, the financial mechanics of it sent an unmistakable message to every central bank on Earth, especially ones outside the closest alliance of Western economies. If your reserves are held as bonds or bank deposits denominated in another country's currency, sitting inside that country's financial system, they can be frozen. Gold, held domestically or in a friendly, neutral jurisdiction, cannot be frozen the same way. It has no counterparty. Nobody owes you anything when you hold physical gold. You just own it. That single realization reshaped how a lot of reserve managers think about risk. For decades, the dominant question in central bank reserve management was simple: what earns the best safe return? Government bonds from large, stable economies won that competition easily because they paid interest and were considered essentially risk-free. But once counterparty risk became a live concern rather than a theoretical one, the calculation changed. Gold started competing not on yield, since it has none, but on a completely different axis: the absence of counterparty risk. An asset that cannot be frozen, sanctioned, or defaulted on by another government became more attractive precisely because of what it does not do, not because of what it earns. The first group of worried banks comes into focus here, and it's worth being precise about which banks these actually are. These are not commercial banks worried about their balance sheets. These are central banks, monetary authorities, worried about their currency's long-term credibility and their country's exposure to a financial system increasingly seen as a tool of geopolitical leverage rather than a neutral utility. Their gold buying isn't a bet that the price will go up next quarter. It's closer to insurance, purchased regardless of price, because the point isn't return, it's independence from a system they no longer fully trust. That raises a natural question. If central banks are buying gold for reasons that have nothing to do with price forecasting, does that even matter for where the price goes? It matters quite a bit, actually, because central bank buying tends to be price insensitive in a way that private investment demand usually isn't. A hedge fund buying gold cares about entry price and will often reduce buying as prices rise. A central bank rebalancing its reserves toward a strategic target allocation of gold tends to keep buying through price increases because the goal is a percentage of total reserves, not a price target. That creates a demand source that's structurally different from the speculative flows discussed in most market commentary: steadier, less reactive to short-term price swings, and driven by a decade-scale strategic decision rather than a trading thesis. The second group of worried banks is where this gets more uncomfortable, because it involves the ordinary commercial banks that hold people's checking accounts and savings deposits. Their concern about gold isn't that they're buying it. It's that gold's price behavior is quietly revealing something about a problem sitting on their own balance sheets, a problem most depositors have no idea exists. The mechanism works like this. When interest rates are low, banks buy large quantities of long-term government bonds and mortgage-backed securities, because those assets pay a modestly better yield than short-term instruments while still being considered extremely safe. That's a completely normal part of banking. The problem shows up later, when interest rates rise sharply. Bond prices move inversely to interest rates, so when rates climb, the market value of those older, lower yielding bonds falls, sometimes by a significant amount if the bonds have a long time left until maturity. As long as a bank doesn't have to sell those bonds, the loss is only on paper, an accounting entry rather than actual cash lost. Banks call these unrealized losses, and under normal conditions they simply wait for the bonds to mature and get repaid at full face value, never actually booking the loss. The danger is what happens if a bank is forced to sell those bonds before maturity, usually because depositors are withdrawing money faster than expected and the bank needs cash immediately. At that point, an unrealized paper loss becomes a very real, realized one, and if it's large enough relative to the bank's capital, it can threaten the bank's solvency, not just its profitability. This is close to what triggered several high-profile bank failures in recent years. A sudden loss of depositor confidence forced banks to sell bonds at exactly the moment those bonds were worth far less than what the bank had paid for them, turning a manageable, slow-moving problem into a rapid one. Why does gold matter to this story at all? Gold tends to behave as a barometer for exactly the kind of financial stress this scenario represents. When investors worry about the health of the banking system, about counterparty risk within the financial system itself, rather than about a foreign government, gold is one of the few assets that carries no counterparty risk whatsoever. It's not a claim on any bank, government, or company, just an asset you hold outright. So when gold demand strengthens specifically during periods when banking sector stress is in the news, that's not a coincidence. It's investors expressing a preference for something that cannot fail the way a financial institution can. There's a regulatory dimension to this story that deserves real attention, because it changed the relationship between banks and gold in a way most financial media barely covered when it happened. Under the international banking regulations known as Basel III, developed after the 2008 financial crisis to make banks more resilient, physical allocated gold held by banks was reclassified as a high-quality zero-risk weighted asset, putting it in the same regulatory category as cash and government bonds from the most creditworthy sovereigns. Before this change, gold held by a bank carried a risk weighting that made it capital inefficient to hold in size. After the change, banks could hold physical gold without it consuming as much regulatory capital, which removed a disincentive that had existed for decades. That regulatory shift matters because it opened the door for banks themselves, not just central banks, to treat gold as a legitimate reserve asset rather than a niche commodity holding. It's a slow-moving structural change, the kind that doesn't produce a dramatic headline on the day it happens, but gradually reshapes how large financial institutions think about balance sheet composition over years. Combined with the central bank buying trend already discussed, it means gold's buyer base has expanded to include institutions that, 20 years ago, would have had almost no structural reason to hold it at all. These two banking stories don't unfold in isolation from the broader interest rate picture, either. The same real interest rate dynamic that governs precious metals prices generally is doing double duty here, both as a driver of gold demand and as the root cause of the bond losses sitting on bank balance sheets. When central banks raise interest rates aggressively to fight inflation, two things happen at once. Existing bonds lose value, which is the mechanical source of the unrealized losses discussed earlier, and the opportunity cost of holding non-yielding gold rises, since safer interest-bearing alternatives now pay more. Those two forces would normally point in opposite directions for gold. Bank stress should support gold demand, while higher rates should suppress it. What happens when the market has to weigh both forces at once is one of the more interesting dynamics in this entire story. Historically, when rate hikes are perceived as nearing their end, meaning the market believes future policy moves are more likely to be cuts than further increases, the stress-driven safe haven demand for gold tends to dominate, because the opportunity cost argument weakens just as the financial stability concerns are peaking, often because the stress itself is what convinces central banks to stop raising rates or start cutting them. That sequencing, stress emerging near the end of a hiking cycle rather than the beginning, isn't an accident. It's close to how these cycles have played out historically, because rate hikes take time to work their way through the financial system, and bank balance sheet strain is typically one of the later symptoms to show up. Who actually benefits and who's exposed as this dynamic plays out? Central banks accumulating gold as a strategic reserve benefit from currency diversification and reduced dependence on any single financial system, regardless of short-term price moves, since their holding period is effectively indefinite. Commercial banks holding large unrealized bond losses are exposed specifically to a liquidity event, a sudden need to sell before maturity, rather than to the existence of the losses themselves, which is an important distinction. A bank can carry substantial unrealized losses indefinitely without failing, as long as depositors don't panic and force a sale. The risk is behavioral and confidence, driven as much as it is financial. Depositors themselves are exposed to a different kind of risk, one that's mostly psychological until it isn't. Deposit insurance in most of these economies covers accounts up to a certain limit, which protects the vast majority of ordinary retail depositors. But larger depositors, businesses with substantial operating balances, and institutional cash holders above the insured threshold carry real exposure if a bank does fail, which is exactly the group that tends to move fastest during a bank run, since they have both the incentive and the sophistication to act quickly once concern spreads. That speed is part of what made recent bank failures move so much faster than historical ones, since digital banking allows deposits to leave in hours rather than the days or weeks bank runs used to take. Gold investors benefit from exactly the kind of environment where both banking stress and the later stages of a rate cycle coincide, though it's worth being honest that this benefit isn't guaranteed or automatic. Gold can and does underperform for extended stretches even when some of these conditions are present, particularly if inflation proves persistent enough that central banks keep rates elevated for longer than the market expects, which would keep the opportunity cost argument working against gold, even as banking stress continues building in the background. What are professionals actually watching to gauge how this plays out? A handful of specific indicators matter more than the general narrative. Bank unrealized loss totals, which regulatory bodies in most major economies publish periodically as part of routine banking sector reporting, give a measurable sense of how much stress is sitting dormant in the system rather than relying on speculation. Central bank gold purchase data, released with a lag but tracked closely by organizations like the World Gold Council, shows whether the reserve diversification trend is accelerating, slowing, or staying steady. Deposit flow data, particularly the movement between smaller regional banks and larger, systemically important institutions, reveals whether depositor confidence is stable or eroding, since money tends to flow toward perceived safety well before a crisis becomes visible in headlines, and the shape of the yield curve itself, whether short-term rates sit above or below long-term rates, offers a read on how the market expects the interest rate cycle to evolve, which feeds directly back into both the bond loss problem and the opportunity cost calculation for gold. There's a question everyone eventually gets to: what happens next? It's genuinely uncertain, and it's worth resisting the temptation, common in a lot of financial commentary, to present one outcome as inevitable. Laying out the honest range of scenarios serves the audience better than manufacturing false certainty in either direction. The bullish case for gold rests on the combination of continued central bank reserve diversification that persists regardless of price, a banking sector still carrying meaningful unrealized losses that keeps safe haven demand elevated, and a rate cycle that's plausibly closer to its end than its beginning, which would gradually reduce the opportunity cost headwind. If all three continue reinforcing each other, gold has structural support that doesn't depend on any single catalyst. The bearish case deserves equal weight. If inflation proves stickier than currently expected, forcing central banks to hold rates higher for longer or even resume hikes, the opportunity cost of holding gold rises again, potentially overwhelming the safe haven demand story. If banking sector stress fades because deposit bases stabilize and unrealized losses shrink as bonds mature and roll into higher yielding replacements, one of the two banking-related demand pillars weakens. And if geopolitical tensions ease, reducing the urgency behind central bank reserve diversification, that's steady. Price-insensitive buying could slow, removing a demand source that's been unusually reliable in recent years. The neutral case, and it's quite plausible, is that these forces continue roughly offsetting each other for an extended period, with gold trading in a wide range that reflects real uncertainty rather than a clear directional resolution, until either the rate cycle or the banking sector situation moves decisively enough to break the standoff. Weighing the evidence as it currently stands, the structural demand story, meaning central bank buying, and the regulatory changes that opened gold up to broader institutional holding, looks like the more durable component of this picture, because it doesn't depend on any specific banking crisis actually occurring to remain relevant. The banking stress component is real but harder to predict in timing, since it depends heavily on depositor psychology and confidence, which can remain stable for long stretches and then shift quickly once it doesn't. There's a broader point worth sitting with as this analysis wraps up, because it reframes what gold actually represents in this story. Gold isn't rising when it does rise, because it's inherently valuable in some mystical sense. It's rising, in the specific context discussed here, because it's one of the only major financial assets with zero counterparty risk, at a moment when both central banks and ordinary depositors have specific, well-founded reasons to think harder about counterparty risk than they have in decades. That's a fairly narrow, mechanical explanation, not a dramatic one, but it's the one the evidence actually supports. So the question to carry forward isn't simply whether gold goes higher from here. It's this: as you watch financial news over the coming months, are you tracking the right signals? Central bank purchase data, bank unrealized loss reports, deposit flow trends, and the shape of the yield curve? Or are you reacting to price alone, which tends to be the last thing to move and the least informative piece of the whole picture? If this kind of evidence-based breakdown of what's actually happening beneath the headlines was useful to you, consider leaving a like. It helps this kind of long-form analysis reach more people who'd rather understand the mechanics than just hear another prediction. And if you want more of this, subscribing means you won't miss the next one, where we'll look specifically at how the yield curve has behaved heading into past banking stress episodes and what it's signaling right now. Thanks for sticking with this one all the way through.